SK Hynix moved 0%. Moat scores 64 out of 100. Durable. Mainstream financial media sees a towering 76.3% gross margin and assumes unassailable market leadership. However, advanced packaging yields and escalating production costs tell a far more fragile structural story. The lab teardown proves why SK Hynix is actively losing its long-term competitive moat. What operating evidence matters most for SK Hynix Inc.? SK Hynix's competitive moat isn't what it was. And another question, what could weaken SK Hynix Inc.'s moat durability? Demand pressure breaks first. Walk the AI stack, and SK Hynix sits as a Tier 1 bottleneck, controlling HBM leadership, 58% share. The moat here is oligopoly, and it should hold for medium. On the cycle, this layer sits at peak. The one force that could crack it, Samsung HBM reentry, Micron HBM ramp, drums cyclicality. SK Hynix's high-bandwidth memory market share collapsed from 69% to 58% in just 12 months. Micron surged to number 2, overtaking Samsung, and its U.S. shares trade at 12 cents. This walks the yield wall and the per-chip constraints, stripping pricing power from what looked like an unshakable monopoly. Capital is rotating aggressively into hardware packaging bottlenecks, bidding up companies that dictate memory bandwidth for next-generation data centers. Markets price a historic memory boom where DRAM and NAND flash are projected to consume 68% of major cloud service provider capital expenditures. Investors see SK Hynix trading at 9.7 times trailing earnings despite delivering a 400% earnings surprise. But the engineering reality tells a different story. The physical constraint governing HBM isn't raw silicon wafer production. It's micro-bump pitch and thermocompression bonding yields required to stack 12-high DRAM dies onto a silicon interposer without structural warpage under extreme thermal dissipation. Yield is the bottleneck, not capacity. As architectures transition to HBM4, interconnect bandwidth scales beyond 2 terabytes per second per stack, requiring custom logic-based dies manufactured on TSMC's 3nm process node. This packaging transition strips SK Hynix of its sole source leverage. According to Counterpoint Research, Micron surged into the number 2 spot in HBM market share, overtaking Samsung. In broader DRAM, Samsung maintains 38% share, SK Hynix 29%, and Micron 22%. The supplier map is inverting. Here's what's absent from the market narrative. TrendForce confirms that persistent DRAM supply tightness is forcing NVIDIA to lower total HBM configurations per GPU node on its upcoming Rubin Ultra architecture. When chip designers reduce total memory per rack to circumvent supply constraints, total bit volume per node contracts. Demand shrinks. Pricing power evaporates. SK Hynix's yield maturity in HBM3E remains unmatched, but falling market share combined with reduced per-chip memory configurations directly weakens the thesis that current 76% gross margins are permanently sustainable. The monopoly is fragmenting. Quarterly financials showing modest revenue momentum for SK Hynix. The macroeconomic environment is not a passive backdrop for semiconductor makers. It is a violent kinetic wave that dictates whether billions in capital expenditure yield exponential returns or catastrophic idle capacity. Macroeconomic forces are actively colliding with SK Hynix's balance sheet, where capital costs and trade barriers act as immense physical friction against historic AI demand. The Fed benchmark rate sits at 3.63%, 10-year Treasury at 4.64%. With the yield spread normalizing and recession risk pricing low, short-term liquidity fears are receding. Yet for an infrastructure-heavy giant constructing a $4 billion packaging facility in Indiana, persistent long-term capital yields inflate debt servicing costs and tighten corporate R&D expenditures. High interest rates raise the hurdle rate for data center operators, forcing hyperscalers to demand immediate, quantifiable efficiency out of every gigabyte of deployed memory. Macro pressure meets execution urgency. Simultaneously, trade policy is tightening into structural constraint. As trade tensions flare with new tariff declarations between North American economies, international supply chains face mounting import friction. But the immediate catalyst reshaping capital flow is SK Hynix's positioning as a prime candidate for global tech index inclusions. Passive exchange-traded funds, such as the SPY and QQQ, execute rigid rebalancing schedules. When an enterprise transitions into a core index listing, automated passive funds execute forced allocations totaling hundreds of millions of dollars within the compressed window between announcement and effective dates. For SK Hynix, this forced passive buying creates a predictable liquidity wave, momentarily protecting the equity from macroeconomic pressure, while asset managers absorb millions of float shares regardless of broader market volatility. Passive buying obscures underlying forces. Across the Pacific, and geopolitical realities present an even sharper threat to physical production. Geopolitical friction centered on the United States and China technology conflict has materialized into direct operational barriers. Strict export controls implemented by Washington actively restrict SK Hynix from importing advanced semiconductor manufacturing equipment into its massive production facility in Wuxi, China. This single geopolitical choke point threatens up to 50% of SK Hynix's standard DRAM wafer production. If advanced lithography gear remains blocked, SK Hynix faces a binary choice. Write down billions in legacy facility investments or absorb immense capital costs to migrate physical wafer fabrication back to South Korea or North America. Wuxi production capacity hangs in limbo. Compounding these external geopolitical vectors is an escalating internal social and labor dynamic within SK Hynix's home operations. Labor union workers at SK Hynix recently rejected management's proposed wage agreement, triggering fresh contract negotiations during a period of record revenue generation. In high-capital tech manufacturing, labor friction is not merely administrative. It threatens physical plant operating rates and gross margins. When skilled fabrication technicians push for profit sharing amid peak cycle margins of 76.3%, fixed operating expenses ratchet permanently higher just as memory pricing cycles inevitably soften. TSMC's monthly revenue report shows broader AI supply chain sales surging 44.7% year-over-year to hundreds of billions of new Taiwan dollars, confirming that macro demand for AI silicon remains temporarily furious. But between U.S. export restrictions capping legacy plant upgrades, labor pushing for structural pay increases, and trade tariffs raising cross-border logistics costs, the macro wave is creating severe structural drag beneath SK Hynix's operational expansion. The company faces triple constraint. SK Hynix memory is trending higher at $0.12. It is designed to make investors see a permanent geopolitical bridge for AI infrastructure. It wants you to forget about memory cyclicality, the historical boom and bust cycle of chip pricing, and focus on federal alignment. They frame the narrative around state-backed AI dominance. No qualifying executive statement in the last 6 months appeared in official IR releases to challenge this corporate script. The lab decodes a very different physical reality behind the ribbon-cutting ceremony. FINRA, Financial Industry Regulatory Authority, the organization tracking daily short sale execution volumes, recorded a short volume spike to 59.4%. That was a 1.31x jump over the 45.5% baseline. Sophisticated short cohorts were aggressively building positions while management posed with golden shovels. Why are short sellers circling during an historic memory boom? Because operational friction is mounting behind closed doors. SK Hynix workers just rejected a key wage deal, triggering fresh labor negotiations right at peak profitability. Look at the underlying market share numbers from their prospectus. SK Hynix commands a 56.4% market share in HBM, high bandwidth memory, the 3D, stacked DRAM dies connected via vertical interconnects for AI accelerators. They rank first globally. But in broader DRAM, dynamic random access memory, the high-speed volatile memory that feeds active data to processors, they hold 29.1%, trailing Samsung's 38%. Independent research confirms their HBM market share dropped from 69% a year ago to 58%. Competitors are actively stripping away their sole source pricing power. Stock volatility reflects short sellers capitalizing on rising labor costs and customer margin warnings. What management is saying is that they are building an unassailable U.S. manufacturing moat. What the lab hears is a peak cycle capital deployment designed to mask market share erosion. The prospectus reveals where the capital actually flows. SK Hynix raised $26.2 billion in net proceeds from its American depository shares listing at $149 per share. Cornerstone investors committed up to $7 billion. But reading the fine print exposes heavy structural exposure. The word lease appears 93 times in the filing. That reflects massive ongoing fixed commitments, just as CapEx. Capital expenditures, the funds allocated to physical plants and long-term equipment, reaches historic highs. The financial performance looks bulletproof on the surface. Reported in EPS, earnings per share, the net profit divided by outstanding shares, beat of plus 41.8%. That completed a four-quarter beat streak with an average surprise of plus 24.5%. Yet gross margins sitting at 76.3% represent peak cycle conditions, not a permanent baseline. Major AI customers are already pushing back against soaring memory costs. Industry disclosures confirm rising memory prices will drive primary GPU customer gross margins down to 71% in the fourth quarter. Supply chain reports indicate key customers are actively reducing HBM configurations per processor for next-generation architectures. Lower HBM content per GPU directly caps total bit volume growth. Because SK Hynix listed recently, institutional 13F filings are not yet established. Retail traders are left buying the glossy headline, while institutional capital waits for regulatory disclosures. Watch if gross margin drops below 70% or if HBM market share falls under 50% in quarterly industry tracking data. If gross margins compress while HBM share slides below 50%, the structural moat thesis is officially broken. The momentum breakdown for SK Hynix. RSI sits at 64, pointing to bullish momentum, with buyers in control. MACD is currently bullish, with the histogram crossing above zero. SK Hynix's competitive moat isn't what it was. In HBM3E, the company controlled both the memory die and the base interposer routing, a proprietary gate. But HBM4's architecture pivots that base die to TSMC's 3nm process. Foundry packaging, not memory fabrication, now determines who qualifies. SK Hynix still commands 58% market share in high-bandwidth memory, backed by yield maturity in advanced thermocompression bonding that delivers 12-layer HBM3E stacks with significantly lower thermal defect rates than competitors. UBS projects the company will capture approximately 70% of initial HBM4 allocations for NVIDIA's Rubin GPU architecture. The incumbent advantage locks in. In overall DRAM, SK Hynix holds only a 29% market share, trailing Samsung's 38%. Memory cyclicality is taking hold. TrendForce reports that persistent DRAM supply tightness is forcing NVIDIA to actively lower total HBM configurations per GPU node on Rubin Ultra systems. Demand pressure breaks first. Here's the structural reality. In HBM4, the base die is custom logic fabricated on TSMC's 3nm process. This allows hyperscalers and chip designers to co-design the logic base, decoupling the memory stack from SK Hynix's proprietary packaging process. SK Hynix will secure substantial bit volumes due to sheer capacity, but the ability to command sole source pricing premiums will diminish significantly across the HBM4 lifecycle. Architecture determines margin. What SK Hynix is saying, we'll maintain premium pricing through proprietary yield advantage. What the lab hears, open HBM4 architecture strips the proprietary moat that enabled pricing power. The case against this thesis. If counterpoint data shows SK Hynix's HBM market share falling below 50% as Samsung achieves qualification on next-generation Rubin clusters, the pricing moat has broken. Here's the macro picture shaping SK Hynix. Strict U.S. export restrictions prevent SK Hynix from sending advanced chip-making gear to its major factory in Wuxi, China, threatening half its standard memory production. At the same time, potential new U.S. tariffs on imported electronics could raise consumer prices and slow down global factory purchases of memory chips. The artificial intelligence explosion demands specialized high-bandwidth memory, positioning SK Hynix as the exclusive turbocharger attached to NVIDIA's top AI processors. However, main rival Samsung is aggressively rushing to get its own competing chips. SK Hynix operates at the absolute peak of the AI memory cycle, commanding a 58% market share in high-bandwidth memory while pricing power squeezes downstream accelerator margins. In its registration filings, SK Hynix frames itself strictly as an indispensable AI packaging and manufacturing powerhouse, backing this posture by breaking ground on a $4 billion Indiana facility for next-generation HBM 4E production. While corporate PR highlights structural shifts over cyclicality, the lab notes that a forward price-to-earnings multiple of 4.7 and an early lockup expiration on October 8 present concrete near-term friction. Over the next 2 quarters, expect massive gross margins to collide with increasing supply-side pushback from hyperscalers and closing competitive gaps from Samsung and Micron. SKHY logged a solid durable score of 64 in breakdown. Is the bull case or bear case stronger for SKHY? Drop your thesis in the comments. Remember, our engineering analysis here at the lab is strictly for educational purposes, not financial advice. Make sure to always conduct your own thorough research before executing any stock trades. Remember that past performance never guarantees future market results. Subscribe so you don't miss Thursday's deep dive. We're tearing down CrowdStrike. If you want our full breakdown on Micron, the link is in the description. We will see you in the lab.